In this video, I'm going to talk about the role of financial markets and institutions in an economy. So basically, the question is, why do we need financial markets in an economy? I'm going to address this question, but before I do that, let me ask you a couple of simple questions. Let's assume that you have two options. Option 1 gives you $200 on day 1 and $200 on day 2. Option 2 has a different set of payments. On day 1, you receive $350, and on day 2, you receive $50. Now, you cannot save your money for the next day. That means if you are given $200, you have to spend all the money on the same day. Another assumption is that on any given day, you have to make a payment of $100 for rent. With this information, I want you to tell me which option you prefer. Is it going to be option 1 or option 2? Most people, when faced with these options, go with option number 1, because option number 1 provides stability over time. If a person is used to a certain standard of living, they can maintain that standard of living with option number 1. Option 2 does not provide that stability, because you're given $350 on day 1 and $50 on day 2. Specifically on day 2, you won't be able to pay your rent. So, option number 1 is preferred by most people. Most individuals have a desire to maintain their standard of living over time, which is what this example shows you. The point of the previous example is that there's usually a time mismatch between income and consumption, discrete income versus continuous consumption. If you work for a company or a government, you receive a paycheck every month, but you have to pay for your groceries and other stuff regularly. That is what is meant by continuous consumption and discrete income. Another example is the life cycles that people go through. When people are young, they need to pay for a lot of things, and they have limited income, so they are more likely to be net borrowers when they're young. When people are older, they are more advanced in their careers, so they probably have more income, but don't necessarily have the expenses they had when they were young. When you're young, you have to pay for your education, buy a new house, and get transportation, such as a personal car. You have to pay for so many things, and your income might not be sufficient, so you have to borrow money to pay for all those things. Once you're older, you're more likely to be a net lender because you have higher income, but don't necessarily have those expenses. You're able to lend money to those who need funding. These differences between income and consumption at different stages of life create challenges that people have to find a way to deal with. It's a time mismatch that exists. Another example is seasonal patterns. People spend more money during holidays and less during other times, but their income does not necessarily increase around holiday time. Again, there's this time mismatch. They have to find a way to fill the gap. Finally, you have economic cycles. As you might know, we go through boom and bust cycles every 7 or 8 years. This means that every 7 or 8 years or 10 years, the time duration between the cycles is not fixed. There are times when people make more money, so their income increases. There are times when they might be unemployed and don't have any jobs. They have to manage their lives in a way that allows them to pay for their expenses and maintain their standard of living regardless of the state of the economy. Whether it's boom or bust, as an individual, you need to be able to pay for your expenses and maintain your standard of living if you want to keep that. One of the solutions that financial institutions provide for filling these gaps between income and consumption include short-term financing. The credit card you have is an agreement between you and your bank that says, I know you are employed, you have your paycheck, and you're going to receive your paycheck on certain days. So I'm going to give you a credit card so that you can pay for your groceries and other things you have to pay for before you receive your paycheck. Once you receive your paycheck, you will pay your credit card bill. That is a solution that financial institutions provide for this mismatch between income and consumption. Another useful service in this regard is overdraft protection. When banks give you an overdraft, they let you spend money that you don't have, and then once you have it, you will pay them back with interest. Another solution financial institutions provide to deal with issues related to retirement and different life cycles is investment for retirement. When you retire, your income is going to be reduced significantly because you're not working. To maintain your standard of living, you need funding, which comes from your investment made during the time you worked. When you get a job, you set aside some of your income and put it in an investment fund so that you have more funding to use when you retire. Again, This is another solution that financial markets and financial institutions provide to deal with the time mismatch between your needs and your resources at different stages of your life. Now, let me ask you another question. Let's say you have two options. Option 1 pays you $200 if tomorrow is rainy, and it pays you $200 if tomorrow is sunny. That means either way, you're going to receive $200. Option 2 is going to pay you $50 if tomorrow is rainy and $350 if tomorrow is sunny. Now there's a 50% chance that tomorrow will be rainy. With this information, which option do you think is better? Or which option would you pick if given the two? Studies show that most individuals have a desire to maintain their standard of living across all different states of the world. As consumers, we don't have any say in what tomorrow's weather will be. Weather is outside of our control, and we want to maintain our standard of living regardless of what happens. So, option number 1 seems more attractive because it gives you $200 regardless of the weather. No matter what happens with the weather, you will receive $200. This is more preferred. This relates to a broader point I want to make. Future wealth and income could be affected by the outcome of many events that transpire in the future. There are many things we don't control, but have significant effects on our wealth and income. Examples include natural disasters, oil shocks, and changes in interest rates. Natural disasters could be earthquakes, floods, or pandemics. An oil shock, for instance, could occur if a war breaks out in some oil-exporting countries, causing the price of oil to jump by 40% or 50%, directly increasing your transportation costs. This is a shock to your income and wealth, and it's outside your control. Changes in interest rates are another example. You and I don't control interest rates, so we must deal with their fluctuations. If you have a variable rate loan, changes in interest rates will affect your loan, significantly impacting your wealth and income. Related to this risk dimension, I would like to define the state of the world. We refer to this as a complete description of a possible scenario for the future across all relevant dimensions. Agents have a desire to have smooth consumption across all future states of nature. A good example is that everyone has some assets. For most families, their house is their largest or most valuable asset. They want to protect their house regardless of the state of the world, be it flood, fire, or any unexpected event. They want to protect their asset regardless of what happens in nature or things beyond their control. What solutions do financial markets or institutions provide to give us smooth consumption across different states of the world? One is insurance. Anytime you buy insurance, you're protecting yourself against adverse outcomes that could damage the value of your assets and investments. You're saying, I want to protect the value of my asset regardless of what happens in nature. Another example is a fixed-rate mortgage. By applying for a fixed-rate mortgage, you're protecting your wealth against interest rate fluctuations. If interest rates go up or down, you won't be affected. Governments also provide services to protect citizens from income fluctuations. More specifically, if they lose their job, they can rely on unemployment benefits to pay for essentials and maintain their standard of living. Let me summarize what we have learned so far. Agents prefer smooth consumption along two dimensions, time and risk. The time dimension refers to the mismatch between consumption and income. People want to maintain a certain standard of living over time. If they have significant future income, they don't mind selling their future income to consume more now. Anytime you borrow money, you're selling your future income to consume more today. This additional funding can be used to pay for education, student loans, or to buy something you like, such as a car, through a car loan. This loan provides funding for buying the car in exchange for your future income. People also want smooth consumption across all different states of nature. Many unexpected events are outside our control. Examples include changes in interest rates, earthquakes, pandemics, floods, or fires. Depending on where you live and the risks you face, the risk dimension varies for different individuals. The main functions of financial markets are to provide us with options to maintain our standard of living over time and across different states of nature. By buying insurance, you're protecting yourself against adverse outcomes. Sacrificing some of your money or future income ensures you maintain your standard of living across different states. Another responsibility of financial institutions is screening and monitoring. The main responsibility of banks is to channel savings toward the most efficient projects. Let's say I have some savings, you have savings, and others have savings. We want our money to be invested in efficient projects to earn high returns and maintain our standard of living when we retire. Directly engaging with borrowers without financial institutions would be very difficult. Not everyone has the expertise to find efficient projects, and it's time-consuming. Most importantly, there is asymmetric information in this transaction. Borrowers might not tell the truth about their projects, hiding critical information. Knowing this, you're less likely to lend money to them, leading to some efficient projects not receiving funding. Banks can solve this asymmetric information problem because they can request and evaluate information independently. Borrowers must comply with banks' requirements before receiving money. This process of channeling savings toward efficient projects is not straightforward and simple. Incentives matter. Depending on bankers' incentives, their behavior might not align with the goal of channeling savings toward efficient projects. Government regulations might also prohibit banks or financial institutions from channeling savings toward efficient projects, leading to inefficient results. Now, I want to talk about the role of financial institutions in economic growth. To show you the role of the financial system in economic growth, let's assume I have $100 in income. There are two things I can do with my money: save or spend. The amount consumed does not lead to growth. The amount saved potentially leads to more growth and income. The saving rate differs across countries. In the US, the savings rate is less than 10%, while in some emerging countries, it's north of 40%. Some savings go to the financial system. Banks lend a fraction of their money to borrowers and keep some of it in reserve for regulatory or internal reasons. Some of this lent money is invested in projects. Corporations might borrow money to pay dividends or buy back stocks, not necessarily investing in projects. From the total money invested in projects, a fraction goes to efficient projects. For example, a pharmaceutical company might invest in 10 projects, but only 2 are efficient and lead to positive outcomes. Some fraction of investments in efficient projects leads to productive capital, which produces more income. The chain of growth goes from income to more income, with financial systems playing a significant role at multiple steps. The effectiveness of financial systems in using funds determines the ratio of money transferred to financial systems and lent to borrowers. Financial systems and institutions play a significant role in economic growth. In most advanced economies, financial systems are well developed and effective in channeling savings toward efficient projects. Financial markets allocate resources and influence societal well-being. I'm going to define the conditions under which resource allocation by a decentralized competitive economy is efficient, assuming no central planner or government dictates everything and decisions are decentralized. Competitive firms make decisions. I will define a model economy to see the conditions necessary for efficient decentralized decision-making. Let's consider an economy with no element of time, simplifying our discussion. We have a large number of economic agents ensuring no monopoly. There are N goods and services, with consumers possessing certain quantities of each. Agents can trade their goods. We also have a large number of firms taking goods and services as input to produce other goods. Agents and firms act selfishly. This means agents trade their goods to maximize their utility, and firms make decisions to maximize profit. For general competitive equilibrium, we need complete markets, perfect competition, risk-averse consumers, and decreasing returns to scale in production. With these conditions, markets will clear, and independent decision-making of agents will lead to an efficient outcome. Even without a central planner, the free economy will generate the best possible outcome. Under certain conditions, selfish choices of individuals and firms lead to the most efficient and optimal outcome. The most important conditions are complete markets and perfect competition. Government intervention is useful when these conditions are violated. For example, if there is no active market for certain goods and services, the government can act as a buyer or seller of last resort. This way, the complete market requirement is satisfied. Similarly, if a large firm uses monopoly power to increase prices and pressure consumers, the government can intervene and create more competition. In these examples, individuals and firms make their decisions independently, and the government intervenes if complete market or perfect competition is violated. Previously, I mentioned our economy is timeless. Now let's relax this assumption and see what happens when we introduce time and risk. With these new dimensions, the number of goods and services increases significantly. For example, an ice cream delivered today is more valuable than one delivered tomorrow, leading to different prices, and considering them as different goods. Similarly, with risk, an ice cream delivered on a hot day is more valuable than one delivered on a cold day. Increasing the number of goods and services makes complete markets less likely. However, it is proven theoretically that as long as there is a market for at least one good over time, and across all states of nature, the complete market assumption is satisfied. So what this means in plain English is that you cannot have a futures market for every single good or service that exists in the economy. You might have a futures market or insurance for certain things and certain events, but as long as you have one good that can be traded over time and across different states, then the market is going to be complete. You can exchange them. You can't go to a home builder and say, I want to buy a house in 20 years. But what you can do is save, put your savings in an investment account, receive interest, and then exchange your money for the type of house you were looking for 20 years earlier.